We're looking at the most anticipated report for 2025. It's the forecast, and Gary Glover's been doing this one for years. But it's been a few years since we got this much detail, and those who have followed it for previous couple of times, you've seen the highs and the lows really edge out and been quite accurate. Sometimes it works exceptionally well, and this year we hope to see something like that. Gary Glover, it's a lot of research that you've put into this. We're talking about cycles, presidentials, 10 years, 60 years, which can be a lot to digest, but you've put a lot into it. So good morning, and thank you very much for preparing it.
Thanks, Chris. Yeah. Look, it's I didn't do an extensive one last year. I probably know. I do know why, because it does take a bit of work to go through. But it's interesting work anyway to have a look at it. But it's always it's always interesting to sort of try and go back and look and see how your forecasts have gone. So even though last year I didn't go too much detail, I think the market ended up being a bit stronger than I anticipated in the first half, but really everything else was pretty spot on there. We've sort of really had that strong second half there. I think seasonally you had, a little bit of an April high, and the May low was kind of touted as, if we saw a May low, that's probably going to be the buy of the year. So I don't know. I mean, he probably would have been better to staying long early, but that was the only reasonable dip during the year was the May low, and that And then the thing about election years as well was that you typically didn't have large drawdowns and pullbacks. So I think 6 to 8% was about as large as history sort of throws up in those years. So you don't get too many decent sort of drawdowns there. So any sort of 6 to 8% pullback just should be caught. Which definitely was the case there. I think we only got one around 8, and the other one, I think all the rest were probably pretty skinnier. So, and obviously finished pretty strong end of the year. They had a little bit of a dip in October there, which we've seen. October 22, October 23. So October 24 was always going to probably throw up a little bit of dip as well. So, but yeah. So look, the main thing with the forecast, Chris, is sort of having done these for a few years here, I'm finding I'm better at the timing than the price. I find the sort of if we look at sort of when we're most likely to see sort of dips, peaks and troughs, I guess is maybe the best way to describe it, and what the pattern for the year might be as well. And we're seeing there with the last few years have really just sort of followed the presidential cycle pretty closely. And if you look at the Decennial cycle, which is the 10-year cycle, we've followed that. They've sort of been in alignment there for the midterm year and for the election year, and it's been the case. I think the start of last year was probably the only anomaly there. It was pretty firm. There wasn't too much weakness there, really. That's pretty much the way we look at it. So it's had a pretty strong year. It's had 2.25 strong years there now. So that throws up some risk here, but history sort of shows, that particularly with the 50-year coming up there, the getting too negative after a couple of bullish years can be the wrong move. So we'll go through some of the cycles and then lay out a bit of a forecast.
Well, definitely, and just to echo on what you said there, it wasn't so much the magnitude of the movements, it was timing the highs and the lows, which can be so incredibly helpful. When I remember, I think I'll highlight it here on the chart, where you were saying, look, my models say there are 4 models overlapping each other. This is the time to buy. And it was right at that point, just before that turning point, actually, like this Tuesday recording before it. I think we called it Get Your Shopping List Ready. And you ended up just loading up and listing all the companies that had higher highs and ones that you were ready to take on this rally with. And you were happy to hold that sort of until this time in the calendar. You weren't quite sure when. So the timing is really critical. And then when you look at your picking of momentum companies throughout the time and the leaders to choose at the buying points, that becomes really critical to performance. So we don't necessarily need to know how far the index will go. Just we decide what we're buying at the time, because you've identified when to buy, and then get quite tighter stops when it's time to sell. So that's discussing this with you for years and following your reports, that's what I found most incredibly helpful. And from here on in, it's a really big learning experience because this is something that you've spent a very long time researching. So I'll hand back over to you. I've got my listening ears on. I'm going to be learning, and hopefully the viewers can take a lot from this as well, because every single year I really enjoy this refresh. So first one here, the 4-year presidential cycle. Can you walk us through that one, Gary?
Yeah, so in the early days, I used to just to do my forecast, and then I reference a few things there, but not really lay out the reasoning or the rationale. So now I'm sort of really, laying out the cycles, the rationale, and what I look at. And, so from an education point of view, I mean, you're kind of learning all my secrets here as to how to do it. At least give yourself a reasonable forecast there. If the thing about doing a forecast is not so much, to say, hey, I got it right or I got it wrong there. It's to try and give yourself a reasonable roadmap so you can trade for the year. That's why I do it. I just want to know when I'm most likely to see strengths during the year, what the cycles suggest, are they good? Maybe when you're most likely to see trough, or when you're likely to see market open at shoulders, and then, whether the cycle's bullish or bearish that year, or what half or what quarter, when the riskiest period of the market is, if you look at the cycle. So I don't do it for glory. I try and do it actually map myself out a roadmap for the year so I can trade with more confidence when I see the right things set up here. So that's the main reason I do it here. So if it is, from a cycle point of view, there's lots of different cycles there. I mean, there's, like the obvious one here is the 4-year presidential cycle. That's the most, that's the one that people talk about quite a bit. And we do definitely have a certain setup in those cycles as well. And we talked about, just looking at that, I in the midterm year, we laid out the October midterm year sort of lows there. If you just go and drag a 4-year line, if you've got a little cycle line, just go, 4 years apart, every October midterm year cycle. If you go back, 50 years, you'll be horrified how many. It's just an anchor for the market drawn down on the lows. It just pulls markets down into those lows there. So it's often that markets tend to sort of get, and I'm drawn down in there. And there's other cycles as well, which sort of pop up over and over again. But if you look at the 4-year presidential cycle, we know that election, that sort of election year is the sort of generally the second strongest year, and the pre-election year is the strongest year. So we've just really had those two. And now we're sort of coming into the post-election. So the interesting thing with the post-election year, Chris, is that I've got some older charts and stuff there where it show you the post-election year being the third, being one of the weaker years. So in recent years, in the last sort of 20 years, it's actually improved to the point where now we get sort of the same, we've had the same average return in the post-election as we've had in the election year, where that wasn't the case 20 years ago. It was actually quite a bit less. So seeing an improvement in recent times there. When you've got a new president elected there, you're seeing definitely lower returns for the post-election year. So that's a bit of a negative this year. But yeah, I guess the other thing too is I tend to look at the seasonal pattern as well, which was sort of laid out there for the post-election year. So obviously we've got a new president there, so we've had the incumbent party has lost there, and that's the red lines. That's the weakest of the cycles there. The interesting there is that if you look at the Democrats versus the Republicans, first-year Republicans tend to do a lot worse too as well. So if it's a post-election year, so we've all the statistics are actually showing this as being one of the weaker patterns for a post-election year. So it doesn't mean we're not going to doesn't mean we're going to go negative or bear market. It just says that this is not, of all the sort of looking at all the statistics, this is the weakest model there. So I think it's sort of averaged around 5%. This getting a Republican in and new party in the first year sort of so it's a bit more of a bit more of a slog throughout the year. So, and I guess if we've had a pretty strong couple of years, that makes sort of sense as well. I do find that, if you look at the Democrats versus Republicans, there's actually it's actually a massive difference between those historically, which is, I did find quite surprising. So, I don't know why that is, but yeah, Republicans tend to amplify. I think it was something like, might be like 11 or 14% return, Democrats versus like maybe 1 or 2% return for the Republicans for the first year and for presidential. So so historically, Democrats have definitely exceeded Republicans quite substantially. But we did know that Trump did all right last time, so that bodes in his favour this year.
Well,
I guess if you look at that pattern now, I think all the I look at the S&P 500, the Dow, the Nasdaq, they all have the sort of same there. It's pretty choppy there for the first couple of months, but we did see like a bit of a broadening sort of pattern with a lot of those things there. We definitely saw a bit of a choppy there, but we saw some sort of early weakness into either February or early April. But a lot of them were in March there. I think it might have been 1935, 1945, 1955. They all did a broadening pattern into March and then rallied there. And I think something like I think we saw the same in 05 and 15. There was sort of like a broadening pattern early and then a rally out of a March low as well. So very popular pattern in 50 years is to have that sort of choppy first couple of months, a bit of a dip into March or April and then rally through. So that's the sort of the presidential sort of cycle. The 10-year cycle is the most interesting because it's just really it's really jumped off the page the fifth year. I mean, up until 2005, we'd never had a negative fifth year in the history of the markets. And the data, even sort of prior to, I mean, the last two fifth years actually have been negative, but not by much. I think less than 1% and maybe 2.5% or something. It's pretty small. But historically, the fifth years, the performance has been more than double any other year. So
that was an amazing statistic. When you shared that late last year, I was quite shocked. So when you're saying the fifth year, you're talking about 2025, 2015, 2005. They end in a 5. That's the fifth year.
Yeah.
And that's this massive climb here on the chart, is it?
That's right. Yeah. So, I mean, you think about, like the 10-year cycle is a really good roadmap just to, if you're going to learn one thing, I'd learn the 10-year cycle. If you sort of know that they say like the 0, 1, 2 years. So 2000, 2001, 2002, 2020, 2021, 2022. Those are your sort of, your first couple of years are sort of negative years to like. So that's sort of where you go through your bearish phase. And then normally sort of the end of the second year, so like your October 02, obviously we know October 22 is when you're sort of the big lows come in. Sometimes it can be the first quarter of the third year. So I think we had 03 there. Was a March 03 low there at one stage for us. It's like, but that's sort of when, usually the bear market, it usually ends and then they can get a transition there. And then, if you go from that sort of late second year, you have a pretty positive third or fourth year. They're pretty bullish years. And then, but that's probably the point where we've had a couple of years up. Everyone thinks, we can't keep going. But, it's, and then this is when the markets often open the shoulders there. It's sort of, there's been some big years there. So, I mean, we're talking about sort of 20, 30% returns in a lot of those fifth years. So, quite bullish fifth years. So, and only the last two have been pretty weak, whereas I think prior to that, most of them are pretty strong there. And that they've often come on the back of some pretty decent moves as well. So, so it's just interesting there. Look, I think we've had a couple of big years here. So that's the only thing to sort of be mindful of there. But
you've got a nice table that sort of puts this into perspective. So you're talking about the fifth year, which we're highlighting here in this column, and the average return is 26.1, which is just massive. And is that what you're talking about? So in the last couple of fifth years that we've seen, they've actually been sort of the first underperformers for the fifth year when we just had kind of a century of massive outperformance in the fifth year. So
That's right. Yes, you know, had some pretty big years in the fifth year. So yeah, and then I think the sixth year is sort of known as a bit of a tale of two halves. It's a bit of a I think it's sort of bearish in the first half and bullish in the second half, and then the seventh is actually a bull year, but can have a last quarter surprise. Some of the biggest corrections in history have come in the last quarter of the seventh year. And then the eighth and ninth, normally bullish years, but can be volatile. And then, you're definitely sort of topping around that sort of 10th, year as well. So, like that pretty bullish the eighth and ninth years, but then you're sort of starting to roll off here, back in new zeros again. And that's when the bear phase often sort of starts here. So, it looks just interesting. It's just, I think we've just seen in recent years was definitely seen some more bullish, sort of third or fourth years, and maybe these, we have seen some bullish fifth years as well. But I guess the fact that we've had two pretty decent sized years back to back, maybe that just puts a lid on this not being a 20, 30% move. Maybe it's just going to be a 10 or 15%, or maybe an 8, 10. Yeah. So just gives us an indication there that, historically, there's a sort of the cycle here anyway. But as I say, there's no guarantees of these things. You always get, if you look through the stat seals, there's always an anomaly here and there. But historically, pretty buoyant period.
Okay, so historically a buoyant period, you're looking at the market through a few different lenses, and obviously you're not predicting a price, but it's helping you understand when it's seasonally strong, when it's seasonally weak, when it's a bit indecisive, and when there are really strong signals like you had in the October lows that benefited from really well. So
if the things I look at, Chris, I look at the 4-year presidential cycle. That's probably the first thing I look at, sort of where we are in that cycle. And I look not just at the performance each year, but I look at the general pattern of that year as well. So does the so look at the seasonal pattern for each of those years there as well. So there is a seasonal pattern for the presidential cycle. And then I look at the what they call the decennial cycle, which is the 10-year cycle. So the 10 year is important to look at the 10 and 20, the 30 year and the 60 year. I personally find that looking at the last two, the 10 and 20 is pretty important. And then also the 60 year. I mean, the 60 year has been really important for a few years. It can be really, like, the market tends to follow the 60-year cycle pretty closely for a few years. Then it will sort of go away from it, and then it will come back again as well. So if it goes away for a year, it tends to go away for 2 years, and then it comes back, and that sort of stays pretty true there. And some of the, having followed the 60-year cycle for a few years, there's some of them really follow the 60-year pretty closely, and we follow the 60-year pattern the last couple of years very closely. It's been the roadmap. It's been probably the best roadmap to look at. So you can't sort of dismiss the 60-year cycle because it does have a lot of validity. Dan often referred to that as the master cycle, but you'll see, like a lot of cycles guys do, is they'll get the 60, the 10, and the 20, and they'll smooth it out. I'll get an average, and I'll overlay the presidential cycle. They might actually overlay a median, the yearly sort of the pattern as well. So like your sell in May and all that sort of stuff. And so I'll sort of do a best fit. And that's how a lot of cycle guys look at the picture there and smooth it out. That's how they do a lot of their forecasts for the year. So if we, I think it's important to look at the 10 year and the 20 year. The 10 years kind of, which is 2015, is an interesting chart there. So it does fall in line with most of the fifth years in that it's a broadening pattern early. So we do see pretty, quite a choppy sort of run. So we tend to sort of either run into late December or early January and then have a pretty choppy period, then kind of broaden out. It doesn't really have the weakness into March. It has more of a weakness into that sort of early February. But then it really just gets in a bit of a holding pattern there. It sort of expands out to May and actually hangs around till July and then actually falls into August. So this cycle actually almost inverts. So it almost does the almost does the somewhat on the opposite to a lot of cycles in that is that normally we get a bit of a broadening pattern early and run into a March low and then tend to run throughout the rest of the year with a few dips. It tends to run up into August. I think if you look at I looked at every sort of fifth year, and I'd say probably 8 out of 10 of them sort of ran into August and then had a bit of a dip into, had some weakness into October before finishing the year strong. So that's the sort of normal pattern there. This is almost like this is the anomaly. And it's interesting, the 10-year is kind of similar to the 60-year. So the anomaly is one that I would normally sort of rule out, but because it's sort of somewhat similar to the 60-year pattern, I can't really rule it out there. So it's just one to sort of,
So 2015.
Yeah, somewhat
similar to 60 years ago.
Yeah. So I probably should have really looked at the 2005 chart first, because that's the standard. That's a textbook 5th year, and that's a textbook post election year sort of setup. So big broadening pattern at the start of the year, bit of weakness into the March, April, then rally up into August, have a bit of a pullback. Most of those pullbacks would be probably shallower than that. And 2005 year, most of those other 5th years have a pretty shallow pullback into October and then finish the year pretty strong. But I think this is an interesting pattern here, the 2005, the 20-year cycle. I mean, like 75, 85, and 95 pretty much just went straight up, and didn't. So they were pretty bullish years. So I guys can't see that. I can't just see us coming straight up for the year after 2 big years, and valuation's been pretty high. I don't really see that being the option there. Considering we are a bit extended valuation wise, I could see us having a bit of a broadening pattern here, having a bit of a breather in the first quarter here this year before sort of, grinding higher for the rest of the year with a bit of a dip in October. That does definitely make sense there. So this is the most common setup for the 5th year, like a variational rinse, but most of those October pullbacks aren't quite as large as this one. But considering who's at the helm this year, we could see some volatility in marketeers who definitely got sort of, so to me, this is the most likely setup here, something like this. I personally thought a couple of weeks ago that we'd probably see as a bit of a week, everyone was pretty bullish end of December and felt like everyone was, this was 100% invested. So this story felt like there was no one left to buy because everyone was already so long and so bullish. So I thought we might sort of weaken off into the inauguration and then rally now. So we haven't. So we did weaken off, but we bounced before the inauguration there, maybe about a week beforehand. So, but we just might get this broadening pattern here. I'm still thinking it might be a little choppy here in the first quarter there. That's just what history tells us there, but it could potentially broaden out. The only reason I don't think it'll broaden out, Chris, is I think those levels on the Dow, the S&P, and the NASDAQ have already hit the critical range expansions. They've already done 100% expansion of the previous range. So I think those highs are going to hold here. So if it's going to be a retest, it'll be, there might be something like this where it does a marginal new high. So we could go back and retest the high for sure, like in February. That's often what does happen there. So we could go back and retest those major expansions. And I think the S&P 500 was the only one that fell short about 20 points of the expansion high. So that could go back and retest that. So that's a definite possibility here in the short term. So, but I still think we'll see a little bit of weakness there. But yeah, so that's the most common setup. That's the way, that's similar setup to the 4-year cycle. And that's the most common sort of 5th year. So that's what and greatest probability is sort of something along those lines. It might be the same sort of size moves, but I think peaks and troughs could follow this pattern here. That's what I think most likely is going to happen. But the plan B, the other possibility is that sort of 60-year pattern there, which does sort of coincide with that with that 2015 setup as well, which is, you got a little bit of a broadening pattern there early, but probably actually tightens up rather than broadens, and it does sort of stay in a bit of a range bound there, but it ends up, instead of trying to find a low, it actually runs up into May and then sort of inverts again into that. I think it comes in finds a low slightly earlier here in the 60-year into June there, but it stays weak until August, which is kind of the inversion on something. So sometimes the strongest cycles there, they can invert. So when you think, like 8 times out of 10, it's the August high, the 1 or 2 times out of 10, it could invert. So like actually August could be the low as well, because that's just the most prominent cycle. So sometimes it does invert there. I saw once the 60-year cycle, so it was running pretty tight all year, and then it inverted for a couple of months, and then it went back to the normal cycle again. So you can get a sort of slight skew there, but that's the other possibility there. Maybe that's an option there. Obviously, Trump's got the market, rolled up here. Maybe you can kind of get it going here. Maybe it'll just consolidate. Everyone think he'll, make America great again. Sort of the bull market, just kind of rallies here, then consolidates, then rallies again, and then, maybe we're 3 or 4 months in and maybe not much has changed, and then, or maybe something negative happens there, like inflation or something there, and then, or maybe jobs, maybe jobs dry up here. But yeah, something might trigger a bit of a sell-off there, potential. So that's the possibility. And then you rally for the rest of the year and then finishing your highs there. So that's the plan B for me. I don't see that one happening. That's the the least likely of the setups that I think will occur here. But that being the 60-year cycle, the one that the market's followed the closest the last few years, can't rule it out. Yeah. So if it wasn't a 60-year cycle, I probably wouldn't even include it. But because the 60 years is such a good roadmap, it's been so strong here recently, so definitely got to respect that. So it could line up here. So
All right. So this 60-year cycle, it's definitely been the stronger one. When I talk about your previous years of doing this kind of report and having really accurate timing on the highs and the lows, that's where the 60-year cycle and the best performances also had the 20-year cycle and the 10-year cycle overlapping. And just to reiterate that
one thing with I guess like the commonality with all those sort of cycles there is that they're all quite volatile first quarter. So we've got Trump coming in here trying to make some waves as well here. So yeah, so even before he got in here, that's the cycle. So with him in here, that makes it super clear that it's going to be could be quite volatile. We could get some pretty decent swings both ways here, which has been the case there historically in the early 5th year and also early post-election year cycles as well. So it really does fit pretty well for the first quarter. We're sort of hoping for a nice expansion and nothing too deep. We're not seeing massive sell-offs here in these first quarters there. You're just seeing a bit of a broaden pattern there, just expand out to sort of new highs and new lows there. So, but yeah, that just might sort of temper the upside there. And there's some reasons there as to why we should be, a little bit, we should be positive there. Obviously, with Trump, Trump's obviously pro-business, pro-market. He's, tax cuts coming and be positive. Obviously, deregulations obviously be positive passes. Has been a pro-Wall Street touch before. So, but the negative is that we do have valuations pretty high, and we do, I think, debt's pretty high at the moment. Credit cards spend's pretty high. Savings have gone down. So, got a little bit of inflation hanging around here. So, cost of living expenses are up. So there's a few.
exactly sorry when the market.
Yeah, there's a few headwinds there, so yeah, I don't know how strong the US economy has been as well. So, yeah, so just be careful not to get too pumped up here by Trump coming in. I think everyone's, we saw everyone got pumped up into December about this being the greatest thing ever. and it's come off there. So yeah, it's interesting. People are talking about this being sort of similar to Reaganomics. So when Ronald Reagan got in, everyone was pretty buoyant there. Had a bit of a move initially, but then sort of had a bit of a choppy period after that. So yeah, just got the ASX. Our sort of market obviously does follow the US market there, but not all the time there. We do tend to follow the Aussie sort of seasonal cycle, and this again we've actually gone away from this cycle in the last decade or two, just because of that. I think we had the GSC in 07, 09, and then we had COVID, 20, 21, 22, so pretty volatile like that. So that's probably throwing this little pattern out a little bit the last 20 years, but this is more the main weather for Australian equities. Is to sort of have that early year sort of weakness there into the probably, either sort of early February or March, and then running through to the end of April and sell in May, and sort of tending to sort of kind of recover from mid-year. Bit volatile through that period there, but generally sort of climbs there, and that's our sort of season pattern there. The thing we've got coming up, Chris, is probably got an Australian election in May this year. I can't confirm that.
But nobody knows just yet. But
that's what looks pretty likely is a May or around that time frame there. So that will throw up a little bit of uncertainty around that period as well. So and then depending on who wins, is how the market feels about that as well. So, but I guess there's a few things there going on. I say let's look. Those 50 years are normally pretty bullish. We've definitely got we've got AI in swing at the moment, and it feels a little early in the AI kind of where we're sort of sitting in there. Feels sort of fairly in its infant stages there. I think you'll see a lot of companies start implementing more AI technology now. That might involve a little bit of spend there, but I think that could actually lead to lower costs and improved earnings at a time. So the market will start seeing that as a mechanism to improve earnings over time. So and I think those tax cuts as well obviously are going to be quite beneficial. And just Trump being last time it was really just cut the red tape. There was a lot of like a lot of regulations, so he really went in there and sort of really deregulated that really loosened things up and got businesses going again. So there's still a few good reasons here to be quite bullish there. And if we look at that sort of that 10-year cycle there, even though there's sort of the third and fourth years can be sort of positive, the fifth year has been one of those years has actually opened up and gone pretty bullish. A lot of the time. So so there's still some good reasons as to why the market can continue high here and have a good 2025. The main risk I sort of see is that like December there, we saw everyone get probably too bullish. Valuations aren't exactly on the cheap side. So a lot of sectors are pretty expensive there. If you look at that, the Cape-Shiller ratio there, that's around about 30. Oh, that was 38 recently, which is pretty high there. It's like the third highest valuation of all time there. So that's telling you that there's equities are pretty expensive. They were seeing obviously you're seeing Buffett and stuff there start to accumulate cash there. The things with these things is they can go higher there. That's the thing. I mean, you've got a momentum market here. So you've got a market which is sort of pretty bullish the last couple of years. So it does have momentum. So they can get more expensive. And, as we know on the Friday, Chris, we've seen a lot of momentum shares this year here definitely run a lot further than most people thought. And the stocks that have been negative have actually run a lot further down than we thought as well. So, it hasn't been the great strategy the last year trying to buy value because they've gotten cheaper and it hasn't, and selling expensive stocks hasn't worked out well either because they've gotten more expensive. So we definitely have a market which is very momentum oriented. So even though we're sitting pretty high, and that sort of tells us that our long-term returns are going to be skewed on the lower end. So we know entering here now is going to give us lower returns for the long term. Still means you still can go higher here for the next 6 or 3 months or 12 months. We've still got, we've seen here that markets can still keep going here. So that's the thing now. I think, the big negative I see, Chris, is I think consensus is around about 12% from most analysts in the US. And we know, and last year they were pretty conservative, pretty flat, but we had they were all expecting very little returns last year, and we got big returns. And this year they're expecting big returns, so probably means that we're not going to get big returns. So, and generally they're not very bright. And so that's the negative I see there. But I guess we do have momentum. We've got Trump doing tax cuts there. So the market's going to get, I guess the two risks are inflation and employment there. So I feel like the market's Powell's done enough here to really, after initially getting it wrong, inflation, he, quickly, turned the corner and got it under control here. Even though, feels like it's taken a long time to get it under control. That's, in history, it's never got under control quickly. It's always taken a long time to get under control. So, yeah, we might get a little bit of an uptick in inflation there, but I don't see him letting it go again like last time. So I view that as a less risk. Kind of think jobs could be the key for 2025. So, if we don't see it, if we saw unemployment start to rise there, and if we did see a little bit of inflation pick there, that's probably the greatest threat to the bull market of 2025. So, but the cycles are still positive, but they're definitely a little bit more measured than the last 2 years. So I kind of think we're probably going to see a positive year, but not. I think it might be single digit rather than double digit like we've seen the last 2 years. So, I think we'll see a bit of volatility in the first quarter. Hopefully we won't see that volatility in the second quarter, because that's sort of more of a bit of a bearish sort of setup, that 60-year cycle turns a bit more of an aggressive sell-off here. So just, if we use our sort of standard sort of 60-year and our standard post-election year, we definitely got a little bit of a broadening pattern in those first few months. So we might, we could even broaden out to a new high here. But I think we'll get a bit of a dip into April, a bit of a recovery of the high again. And then again, sort of August is a lot of highs around there. So still think we'll grind higher into August, maybe have a flatter sort of dip in October there, and maybe finish the year high there. That's what I think. That's the sort of, that's what the odds prefer. It's not, maybe a little bit of a boring setup here. But the greatest risk will be the first quarter here. That's tend to be we've definitely seen volatility in the first quarter and pretty much every 50-year, but maybe bar 1 or 2. So I think the first quarter is going to be pretty volatile.
And just echoing on these blue points once more, it's the confluence of all the other patterns that you've looked at and putting them together. And I'm going to go back to this chart here, which is taking out, sort of looking at the rally into March, which is this first blue one, and marked on the bottom axis here, March. Then coming into sort of that late April, May low, another point, August peaks. So if these are sort of the key points, the key pegs to look for throughout the market in 2025, we don't necessarily know how far it will go, but we got a feeling that, well, maybe March to August could be a very solid period of gains. And then after those October lows, which we've seen for the last 2 years, we can have good rally into year end. And so I'm just taking those blue points that we marked on the chart, those days. Sort of
it's an interesting setup, that 05 here, because it sort of found a high around the 31st of December, pulled back into the 24th of January, broadened out to the 7th of March, and then broadened out to low to the 20th of April there. So we found a high, I think, in the first week of December. So maybe 2 or 3 weeks earlier. And we found a low here probably a week or two before this low here as well. So if we sort of follow this sort of pattern here, maybe we're going to rally up into late February and then find a low in late March, early April there. Just similar sort of setup, but maybe just a little couple of weeks earlier in time here. So that's one that I was sort of, definitely feel like that's worth keeping an eye on. So like, yeah, if we did broaden back up again. So,
So if we get these dates here, it could
yeah.
bode well for this being a blueprint for us to follow for the rest of the year to see whether we're going for, was this one plan B, and this is plan A.
Yeah, so that's what we're sort of hoping. That's what I sort of hope for. That'd be a good setup there to have there, because then it sort of gives us a bit of a rally here to the next month, which is nice. We're all probably, most of us have probably got some longs or a few longs here. So we get a nice, get a good reason to rally up here. But then, then after the euphoria wears off, not much gets done, because of the expectations are pretty high, and then when the expectations are high, they're really bad. So then you cool off there, but then we sort of climb after that. That'd be the sort of ideal setup there. So but we'll see there. I guess that other setup there is just the plan B. There is just the 60-year cycle. It's just one to keep an eye on. If it starts tracking that, then it might be a little bit, might be something sort of different to keep an eye on that as well. So
there's definitely a lot more data on the S&P 500. There is some strong correlation between the Aussie and the S&P. It's obviously FX. We have a lot more commodities, and we didn't go as deep into the GFC as what the US did. Tended to avoid those recession cases, partially because we constructed and dug our way out of issues from the Australian economy perspective. So understanding there's a whole lot more data and seasonality into this kind of cycle in the S&P 500. But it seems like you may have pulled some of these key dates, the blue points, and used that to extrapolate for the Aussie. So can you just walk us through your Aussie and how that came about?
yeah, look, the Aussie one's going to be a little harder there. You've got a few things going on there. I think, I can see parts of the market like growth and financials being vulnerable here, but I can see materials, commodities being pretty buoyant here. So that's going to make it a little bit hard to sort of, could be a bit of a choppy market there. We definitely get that, typically had that choppy first quarter for our market, and also for the cycle this year as well. So that's, I just think you'll see a little bit of maybe weakness there. Maybe we rally up here into February up there and then weaken off into March, April, something like that. Seasonally, April's one of the more bullish months there. So I think we'll be rallying, sort of, through April there up into May there, and then there may be a bit of a, get a bit of a consolidation there and eventually grind up to August there. So, and again, similar, I think we'll just maybe congest under the high here before pushing late there. But the key thing for Australian market is to continue to keep seeing rotation, Chris. We don't want to sort of see all sectors be peaking at the same time. We want to see some rotation there. We want to see some sectors get hot while others have been weak here. There's a few, I think, property trusts are weak here. Materials have been weak here and just starting to sort of, recover here with energy and stuff there. So we might see a few of those sectors there. So as long as we keep seeing the rotation there, then, I think we'll be right there. But yeah, and the other thing we've got going on this year is an election in May, and that can throw up a bit more volatility as well in the the 2 or 3 weeks prior to the election, and then the 2 or 3 weeks after. So yes, maybe a hard year to do the So I sort of kept my forecast pretty generic there, pretty broad there. Just thinking, we'll see some sort of choppy first quarter here, and then again, just that typical weakness into that start of the year, and then the grind there. So, but the key there is just to keep seeing that. Just kind of just got to keep sort of seeing that sort of consolidation there and rotation occurring there. Yeah, it's if we see everything run up at the same time, that's when we sort of should get a little bit nervous there.
All right. Now, there are a few more charts and tables in here. We'll scroll through So have a look at this. So the Stock Traders Almanac, remember you introduced me to this. Can you just
Yeah, look, I just put those in there. I just think they're interesting, Chris. I just thought, if you look at the averages and stuff, that's quite interesting. There, just kind of just tells us there that a Republican president and in that post-election year hasn't done so well here. So historically, we haven't seen too many. The good news is that last time Trump was in, we saw a 25% gain. So that's the upside that he was able to manufacture a pretty good gain there. So, but historically we haven't seen the performance there. Whereas if you look at the Democrats there, the numbers are pretty positive there, pretty good average there. So, So look, I think Reagan went negative then positive. So be careful about Trump going too positive there. Maybe we might get a negative. But yeah, I'm probably more aligned with just a small up year, but more modest there, which is aligned with the sort of the post-year election year cycle, so something around that sort of 5 to 8%. So that's what I kind of think we'll probably get. I think Wall Street's too bullish, 12%. They're never right, so they'll be wrong here. But maybe we'll see something more on like a 5 to 8% gain for the year.
Yeah, well, that'd be the best to see, especially if we're able to highlight the lows and the highs along the way. We could take out more of that throughout the year than what the net result is end to end. You've also put it in here, so we'll just have on screen there a couple of the other tables to read. But you also put in here some interesting posts. So what is it about these that caught your eye, and how does it fit into your interpretation and analysis?
Oh, I mean, look, that Cape ratio at 38 is pretty damn high. And basically you've got yields that, I think they've actually gone higher since this closed quite a few weeks back. So I think the 10-year rate is probably higher there. So, if you want to put, it's all that where you put money. So are you going to invest at a Cape ratio of 38 or put money into a 10-year, get, some pretty high rates. So if you go back to some of these previous periods there when the Cape ratio was this high, the 10-year was pretty low. So you sort of had no choice but to be in equities. Whereas at the moment, with the 10-year being pretty high there, you do have a reasonable other choice there to actually invest there. So that does sort of put a little bit of risk on the table here. The fact that the valuations are so high, and we do have an alternative to ship money into that sort of high rates there. And then I guess the other tweet there is pretty much everyone's so bullish here. It's that not one person's almost for proof if it wasn't negative at all. So considering that where the valuations sit, everyone seems to be way too bullish, way too complacent. So that's just another slight negative there. But we do, I guess we look at, if the market stays buoyant for the first 3 or 4 months here, Chris, and we don't get a pullback early in the first quarter, then I think you've got the risk of that sort of 60-year cycle there, and the 10-year as well, which means we might get a bullish, a bearish hit in the middle of the year. And that might be that's probably end up being a bit of a nasty hit, as well. So that's probably what I don't want to see, because I've seen there most of those corrections were pretty fast. They come off pretty hard in a pretty short period of time. So talking about 30 days to 45-day correction there, coming crawling right off there, having like a
genuine, and you stop seeing day 1, 2, or 3.
Yeah, it's just a pretty sharp, nasty pullback in a pretty short period of time here. So, So look, we'll see how we trade here in the next coming couple of weeks there. But I think I just think it'll be volatile. I think that I can just see it being. I think we'll follow the classic 5th year and post-election cycle. I just think it'll be a little bit. Just can't see it open the shoulders and being too aggressive there, just considering where valuations sit. But there's a lot of things that can definitely, Trump can definitely get the US market, kicking along. As he'll be doing everything he can to, stir business and tax cuts and, there. So there's definitely going to be some, some shots in the arm for the US economy there. So that's why I think it's going to be hard to be too negative this year, even with those high valuations there. It's hard to get too negative.
Well, that's really a good insight for what to look at from the macro fundamental overviews, but the patterns. And this is kind of the question that we regularly get throughout the year is kind of, what do you think in the next 2 weeks or month or so? This report, and this is something that I bookmark and go back through and instead of drilling Gary for all the questions, I already know he's already shared the report. So I go back and review these videos and go, okay, well, what's sort of the setup in the next coming months? What are the probabilities saying? Okay, well, with that framework, I now then look back at my top momentum shares and see, well, is it possible they can really open the shoulders up? Can they really have some outperformance periods? So this framework is really worth coming back and reviewing throughout the year. And it's almost like you'll have Gary in your pocket to look back at references. Hey, what do you think's coming up? So all that research, all that sharing, you really do say thank you very much, Gary Glover from Lovers Capital, for sharing this in-depth report that's super hard to come by and pretty difficult to compile.
Thanks, Chris. It's a good roadmap for me as well. But I'm actually guilty of probably actually doing all the hard work and halfway through the year, sort of not revisiting it. It's a bit like your model books, sort of stuff. You just got to keep going back to those model books, keep looking at the stronger stocks, what they do. So the cycles can vary slightly. So yeah. Probably worth looking at every 2 or 3 months just to sort of see what it's setting up like, and just also having a look and seeing how it sort of looks compared to the other previous 50 years, because it will follow one of those, 1 or 2 of those other 50 years. If you break down every 50 year, there's probably 2 or 3 sort of stereotypes, patterns. So by March there, I think we'll know which one we're following. So that should give us some assistance there for the rest of the year.
No, definitely. It's well worth it and well worth reviewing. So we look forward to another report, another update on Tuesday and Friday's coming report where you'll tell us what you think of the leading momentum shares. Thank you, Gary Glover.
Thanks, Chris.